Welcome to vTalkInsight, Market Drivers Daily for February 23, 2026. Trade rules have just been rewritten in Washington. Oil is carrying a fresh risk premium from the Gulf, and the AI spending wave is colliding with more selective equity markets. Today matters because these three forces are starting to pull asset prices in different directions, with important implications for cross-asset positioning. The trade landscape has shifted sharply as the Supreme Court curbs the president's ability to use emergency powers for broad tariffs. Several existing duties have been ruled unlawful. Collection at the border has stopped, and the average effective U.S. tariff rate has dropped from elevated levels to roughly half that peak, even though it still sits well above the pre-Trump era. In parallel, a new 10% global tariff has been announced on top of remaining measures, signaling that while the legal toolbox has changed, the political appetite for protection remains strong. This ruling opens the door to sizable refund claims, with estimates of potentially more than $100 billion of tariff revenue now in dispute. Import-heavy sectors such as consumer durables and apparel have already reacted, with names like major sportswear and online retail brands rallying on expectations of lower landed costs and possible cash windfalls. However, the process for reclaiming past payments is legally complex. Hundreds of lawsuits are pending, and the timing and scale of any refunds remain highly uncertain for corporate treasurers. Despite the court's decision, the administration still retains slower-moving tools such as Section 232 and Section 301, along with other narrower statutes, to keep tariffs in place on areas like Chinese goods, steel, and aluminum. Some rates on partners including Europe, Japan, India, South Korea, and Vietnam have been cut back toward 10%, but Washington has reserved the right to hike them again after formal reviews, reinforcing a stop-start backdrop for global trade. Earlier moves had already pushed U.S. importers to shift sourcing away from China toward countries such as Mexico, Vietnam, and Taiwan, and that supply chain rewiring trend now coexists with renewed legal and political uncertainty. Economic work cited around the ruling suggests that unwinding the struck-down tariffs could materially reduce the drag on prices and jobs, cutting the estimated cost for the average household to around $800 a year and roughly half that for lower-income families. At the same time, surveys indicate that close to 90% of tariff costs have been borne domestically, reinforcing the view that tariffs act like a tax on consumers and import-heavy businesses rather than a bill paid abroad. Looking ahead, the White House is signaling fresh global tariffs and new investigations just as Congress and courts assert more oversight, so trade policy is likely to remain a key election year fault line rather than a resolved risk. For markets, that means watching the evolving refund litigation, any legislative attempt to restore broader tariff powers, and whether companies accelerate imports again to front-run future measures, even as attention shifts toward the energy shock building in the Middle East. Energy markets are now the clearest channel for rising geopolitical tension, with Brent trading near a six-month high and carrying an explicit risk premium linked to Iran. Estimates suggest that $3 to $10 per barrel of today's price reflects fear rather than fundamentals, as traders handicap the chance of U.S. military strikes in the next couple of weeks. That follows what we have been discussing in recent days as the largest U.S. military buildup in the Gulf in decades, which is now moving from the political pages directly into crude benchmarks. Scenario pricing has become more granular. Base case expectations revolve around limited strikes and containment, but options and physical markets are also gaming more severe outcomes, including disruption in key choke points such as the Strait of Hormuz. In those tail scenarios, some traders talk about oil surging toward $100 or even $120 a barrel, with one reference point around 108, reflecting the fact that roughly one-third of global oil supply and a significant share of total energy still transits through the broader Middle East. Complicating matters, OPEC plus spare capacity is concentrated in Saudi Arabia at about 2 million barrels a day, which may not be enough to fully offset a major hit to Iranian exports, even if Riyadh and the UAE step up shipments as signaled. The macro channel runs through inflation and risk appetite. Rule of thumb estimates indicate that a 10% move in U.S. crude tends to add around 15 basis points to headline consumer prices, so a sustained spike from here could stall the recent disinflation narrative. That in turn would complicate the case for near-term rate cuts and could force the Federal Reserve to lean more hawkish if oil drags inflation expectations higher, even as recent labor data have supported a soft landing view. Equity history suggests that a sharp jump in oil to around $100 on conflict headlines often triggers a risk-off move in cyclicals, even if those shocks have sometimes reversed quickly when actual disruptions prove temporary. Flows have already rotated toward perceived havens, with the U.S. dollar and gold both in demand as investors seek protection against an escalation that could involve strikes, retaliation against Israel, or attempts to interfere with tanker traffic. At the same time, there are signs of market skepticism. Oil and defense names inside major European indices have recently lagged despite the headlines, and risk assets in Asia along with U.S. futures have shown periods of resilience after initial sell-offs. Some analysts also stress that year-to-date crude remains around $20 below peak seen before late 2023 and that ample non-OPEC supply, including a possible 30 to 40% rise in Venezuelan output if licenses are issued, could cap prices if diplomacy prevails. The balance of risks, though, still points to elevated volatility into upcoming U.S. data on personal consumption expenditures, income, spending, and GDP, with every new headline from the Gulf now feeding directly into both oil prices and broader cross-asset positioning before the focus turns back to the AI capital cycle. Artificial intelligence remains the dominant structural theme, but markets are treating it less as a single story and more as a full-blown capital cycle with winners and losers. Hyperscale cloud providers are projected to spend about $600 billion on AI infrastructure this year, roughly $200 billion more than last year, extending the investment surge we have been tracking in recent episodes. Within that, NVIDIA and OpenAI are moving toward a $30 billion funding deal, scaled down from earlier $100 billion plus discussions, but still signaling extraordinary demand for compute capacity in data centers. Capital and equity flows are rotating to match this infrastructure focus. Investors are shifting from software into hardware, semiconductors, and materials that enable AI, and reallocating from U.S. tech alone toward Asian names in Korea and Taiwan that are deeply embedded in the supply chain. North Asian economies such as Korea and Japan are also benefiting from Western efforts to diversify away from Chinese vendors and critical mineral processing, reinforcing themes of supply chain, rewiring, and strategic autonomy around future AI and autonomy platforms. At the same time, bottlenecks are evolving. Shortages are moving from graphics processors into memory, optics, and power, which could drive volatility and more selective opportunities along the component stack. On the ground, AI is already showing up in earnings and business models. One example is digital real estate, where a major platform's stock jumped by double digits after it highlighted its AI strategy, while an infrastructure and security provider reported 45% growth in cloud services and expects 40 to 50% expansion this year on AI-related demand. Across the broader equity market, S&P 500 profit margins are projected near record highs around 13.9%, with AI-driven efficiencies cited as one contributor. Yet disruption risks are rising too. Cybersecurity names sold off sharply after a new AI tool launch from an upstart vendor. Eyewear makers have seen their steepest weekly falls in years on fears of AI-powered smart glasses competition, and hotel operators expect automation to cut headcount by 15 to 20% within 2 years. The counterpoint is that not all AI exposure looks equally attractive. Software valuations in some areas remain rich despite growing fears of business model disruption, and layoffs are emerging among companies that aggressively invested in AI, feeding concerns about a harder landing if job cuts spread. On the funding side, the failure of a multi-billion-dollar data center financing package has highlighted that credit markets may not underwrite every AI infrastructure project, adding a layer of credit risk to what has often been treated as a pure growth story. Still, heavy capex by hyperscalers, tangible productivity gains for early enterprise adopters, and a sense that companies with proprietary data and strong moats may be mispriced after indiscriminate sell-offs all argue that AI will keep driving dispersion rather than delivering a single, neat outcome. Key signposts now are NVIDIA's upcoming earnings and hyperscaler capex guidance, regulatory moves on AI and copyright, and labor market data that will show how far technological disruption is feeding back into the real economy, alongside the parallel shocks from trade policy and Middle East geopolitics. To sum up, tariff authority has been clipped but not removed, keeping trade policy in play just as legal battles over refunds and new global levies unfold. Middle East tensions are embedding a visible premium in crude, raising the risk of an inflation setback and choppier cross-asset conditions, even as some markets still lean on ample supply and diplomatic backstops. And the AI investment cycle is accelerating, with capital pouring into infrastructure and hardware, while valuations, credit strain, and labor disruption make the theme far more selective than a year ago. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.